Hello, everyone. My name is Alexandra Shepis. I'm an advisor here at Francis Financial. Today, I'll be talking with you about our views on the market and the economy as part of our monthly investment insight series. Each month, we'll be sharing these insights on the market trends that impact your portfolio and investing strategies. So with that, let's go ahead and jump right in. Taking a look at where we are year to date, 2022 has been a rough year. Year-to-date numbers are down in most asset classes, with U.S. large company growth stocks suffering the most. Energy and commodities are the only area with positive returns year-to-date. The Federal Reserve moving forward with raising interest rates can be tough on stocks in the short term, as borrowing costs are increased for companies. We also see that the values that stock analysts predict the stocks to be worth tend to come down during periods like the one we're in. Now, looking at the bond side of your portfolio, bond prices have an inverse relationship with interest rates, so they move in opposite directions. As interest rates go up, bond prices go down, as older or longer term bonds are locked in at lower rates and become worth less than new bonds at higher rates. Year to date, bonds are down nearly 9%, which is abnormal for bonds. Short-term results like the first half of 2022 can distort what we know happens over the long term. When we zoom out and look at the last 10 years, the numbers are much, much better. Taking a look at U.S. large company growth stocks, which have been the hardest hit, their 10-year return is 16%, followed by the S&P 500 with a nearly 14.5% average annual return. We'll likely see continued market turbulence, but it's important to stick to a long-term investment plan and to stay invested. Economic news was mixed for the month of June. Inflation rose to 8.6%, which was a new 40-year high. The inflation report was a surprise, as many economists had thought we had peaked. Housing costs, energy, and food costs were big drivers in the latest inflation results. We also saw the Federal Reserve increase interest rates by 75 basis points to a range of 1.5% to 1.75% in June. The Fed had previously suggested that they would be increasing rates by only 50 basis points. The higher rate hike was in response to inflation data being higher than was expected. The Fed estimates that they'll continue to increase interest rates and see another rate hike of 50 to 75 basis points next month in July. The University of Michigan Consumer Sentiment Survey, which gives a glimpse as to how consumers are feeling about spending and their future expectations for the economy, hit a new low. This indicates that consumers view the current economy conditions negatively. However, on a brighter side, unemployment is historically very low with a very tight job market. And economic data is improving. When we review very current informal economic data called high-frequency data, early indications are positive, with credit and debit card transactions up 35% compared to the same week in 2019, pre-COVID. This means that even if consumers have low sentiment, they are still spending money. We're also seeing that people are going out to eat more, with open table reservations up 5%. Along those lines, hotel bookings and TSA airport passenger volumes indicate that people are taking their vacations. These different areas of consumer spending all matter because consumer spending drives nearly 70% of GDP. So when the consumer does well, the economy does well. Near-term volatility will likely continue until there's more certainty about inflation and interest rates. This likely won't be until this fall at the earliest and possibly more towards the end of this year. Longer term, low consumer sentiment generally leads to higher future returns. When we look at economic cycles historically, these dips in consumer sentiment are generally followed by periods of strong stock market performance. The U.S. economy remains solid, with low unemployment and strong consumer spending. It's probable that bond yields may have peaked in the near term, which should stabilize bond values in the second half of the year and get them back to their normal tendency of being the airbag to your portfolio. We review our portfolios on a consistent basis, and our current portfolio positioning is focused on investing in high-quality companies. Actively managed fund managers are picking up new stocks on sale, which will set up the stage for the next cycle of growth. We'll likely see the continued market volatility as inflation uncertainties and recession worries continue in the near term, but it's important to stay invested, allowing dividends and capital gains to buy more shares at lower prices. And for those with excess cash, consider adding to your investment portfolio while values are well off of 2021 highs. When you turn on the TV or go on your phone, there's a lot of doom and gloom headlines, but know that we're here for you to cut through the noise and focus on the long-term plan that we've created for you. We're continuing to monitor the market conditions in your portfolio, and we're here to answer any questions you may have. It's incredibly important to us that we're keeping you informed of what's going on in the market, so please don't hesitate to reach out. Thanks so much for listening.